HC Proprietary Limited has just calculated the allocable cost amount, or ACA, of a joining member of its group, SC Proprietary Limited. It now needs to allocate the ACA to the joining member's assets. SC's main assets were cash in the bank, trading stock, a depreciating asset, goodwill and land. There is a two-part process for allocating the ACA. The first part of this process is to allocate the ACA to retained cost-based assets. These are basically assets that have a predictable, stable value. Note that work in progress is explicitly excluded from being a retained cost-based asset. After the portion of the ACA attributable to retained cost-based assets has been carved out, the rest of the ACA can be allocated to reset cost-based assets. These are all of the assets of the joining entity that are not retained cost-based assets. Work in progress, goodwill, CGT assets, trading stock and depreciating assets are examples of reset cost-based assets. It also includes revenue assets, which are CGT assets whose profit or loss on disposal are not assessed under the CGT provisions of the tax legislation. There are two steps to allocating the remainder of the ACA to the reset cost-based assets. The first step is allocating the ACA to each of the assets in the proportion of each asset's market value as compared to the total market value of the reset cost-based assets. The second step is capping the amount of ACA that has been attributed to reset cost-based assets that are held on revenue account. Broadly, such assets will consist of trading stock, depreciating assets and CGT assets whose profit or loss on disposal is assessed other than under the CGT provisions. For such assets held on revenue account, their tax value is capped to the greater of their terminating value and market value. There are different rules for calculating the terminating value of trading stock, depreciating assets and revenue assets. Note that if the capping of tax value of these assets leads to a reduction of their value, this excess is apportioned to the remaining reset cost-based assets. Let's revisit the data from the head company of the consolidated group, HC, which calculated its joining subsidiary, SC's ACA. SC's main assets were cash in the bank, trading stock, a depreciating asset, goodwill and land. The first part of the process is to allocate the costs to the retained cost-based assets. Here, there is only one retained cost-based asset, the cash at bank. The balance is then allocated to the reset cost-based assets. The next part involves allocating the remaining balance to the reset cost-based assets. The first step of this process is to allocate the balance of the ACA in the proportion of the market value of each of the reset cost-based assets. This initial allocation based on market value proportions is done for the trading stock, depreciating asset, goodwill and land. The second step is to make adjustments for the allocation to the assets held on revenue account. Here, the trading stock and the depreciating asset are held on revenue account. The maximum allocation to such assets must not exceed the higher of their market value and terminating value. For the trading stock, this means that its initial allocation must be adjusted downwards to its market value. And for the depreciating asset, the adjustment is downwards to its terminating value. The total amount of these downward adjustments is then reallocated to the non-revenue reset cost-based assets, being goodwill and land. The amount is reallocated to them in the proportion of their respective market values. As a result, the value of the goodwill is increased by its 20% proportion, and the value of the land is increased by its 80% proportion. It needs to be kept in mind that only certain assets can have a tax value allocated to them under this process. The effect of this is that certain assets that may be recognised for accounting purposes, but not tax purposes, cannot have a tax value allocation made to them. To recap, There is a two-step process for allocating the allocable cost amount, or ACA, of the joining entity. This is to firstly allocate to the retained cost-based assets, and secondly, allocate the balance to the reset cost-based assets. The second part of this process involves making sure that reset cost-based assets of a revenue nature have a value capped at the greater of their market value and terminating value. Any downward adjustments are reallocated among non-revenue reset cost-based assets.